CRISPR is a technology for changing the sequence of DNA in cells in a precise fashion to correct mutations that might otherwise cause disease. It's going to enable a lot of science to be done that was impossible to do in the past. So the way the CRISPR technology works is by the action of a protein called Cas9 that functions like a molecular scalpel for DNA. The CRISPR-Cas9 system has an amazing ability to recognize a particular DNA sequence in a cell that may be malfunctioning and then disable it by cutting the DNA. We call this gene editing, and we can use it to disable or repair a mutated part of the gene which may be causing disease. For Cas9 to find the malfunctioning DNA, we attach it to an RNA sequence that matches the DNA sequence we want to edit. Then we put this RNA-Cas9 combination into the cell. It finds the mutant DNA and uses a chemical reaction to cut the DNA strand right at the spot where it's malfunctioning. After that, we can sometimes insert the correct version of the gene for the cell to work properly again. It's a very exciting technology that's going to do a lot of good in human society and for human health. It stretches from human therapeutics to agricultural applications to thinking about how do we make better biofuels. These would be incredible outcomes, I think, of using this kind of technology in the future.
Alright, what's going on everyone? I'm coming at you with a quick video. This is going to be a video about the gene editing and genomics space. Now, this has kind of been a very excited, very hyped space for a little bit if you know about it. Essentially in around like 2012, this thing called CRISPR-Cas9 was invented, really sent a lot of these technologies and a lot of the venture capital funds for these technologies to new heights, and just we've been seeing a whole new slew of research developments in this space, and it is quite exciting. But I'm going to give you an honest breakdown about just the space as a whole, some of the funds that invest in the space, and what are my honest opinions on it. So what is the major intrigue in these? Like, why have we seen so many funds popping up in this space, so many companies popping up in this space, so many private and public companies popping up in this space? Well, it has to do with the cost per human genome has come down tremendously in the last couple decades. As you can see here, this is a research chart from the NIH. It starts in 2001 where it costs $100 million to sequence one human genome, and it starts ending where it costs around $900 to well less than 1,000 in 2021. Around this middle point where the exponential decline in cost curve really takes hold, somewhere around here is certainly where CRISPR-Cas9 came in. And yeah, I mean, this chart certainly is a sight to behold, and it really just puts into context how inexplainably exciting this type of technology, this field of technology is. Moore's law, which has to do with the decline in costs and the improvement of sequencing and processing abilities, that was once seen in computers. That's actually been evident in the human genome sequencing, especially ever since 2009. Yeah, CRISPR-Cas9 by Jennifer Doudna in 2012 really did propel that trend you've been seeing. One of the other regions that's creating major investor intrigue in this space is just technology is just disinflationary by nature. When new innovations are created, new products are made, it creates new wealth for those people involved. Beta thalassemia, which is somewhat like the sickle cell disease, it has to do with alteration in hemoglobin. These cells get reduced oxygen to them. That was actually solved very recently by a company called Crispr Therapeutics in research trials. And I think with a lot of these kind of like somewhat matured valuation companies, like well over $1 billion in valuation companies, with them really showing this type of research and this kind of capability, I think that's caused a lot of the major investor hype. It's an undeniable actionable step that these companies have done. So that kind of explains it. And it really does pose that question of the future and investing in the future. Like, what diseases can be cured or remedied with this improving technology? So what are some of the purpose, benefits, and what are some of my personal drawbacks towards these ETFs? Well, what we're talking about here is a basket of stocks that are going to fit our theme. Our theme being the genome sequencing, gene editing space. Because we're buying a diversified basket, if one of our companies maybe has a bankruptcy failure, if one of our companies, maybe the research goes nowhere, they just end up being a failure, it's not going to be the end of the world. We have a whole basket of companies that we own. And for every company that hopefully, unfortunately, inevitably almost, when we're talking about this type of like venture technology, has those types of failures, we're going to have one company in that basket that just really takes off. Great research, ends up developing a great product, gets it through all the trials, very successful company, and creates a ton of wealth and a ton of opportunity, a ton of new, that's really going to protect our wealth, and ultimately it is going to create a lot of wealth. Like 100% downside is nothing compared to like 300,000% upside, or whatever number. Stocks can really go up. Diversification, yeah, I'm afraid so. Now, what I mean by that is, unfortunately, these funds will have to just prove a lot of fund managers, they'll have to prove a lot of index, kind of like, and a lot of like bigger major shareholders happy. And because of that, they're going to have to hold a good amount of companies. And although they may have some like crazy high conviction in one company, they can only hold so much of that, and they will have standards for, you have like great conviction in this one company, you're like a manager who's been investing in this space for like 10 plus years now, but no, we're only going to let you hold like 8% of this company tops allocation of the portfolio. He might want to do something closer to like 25-30. Because he's got that crazy high conviction, and he's the fund manager. But even the fund manager of these funds, these commercial funds, are going to have immense rules and scrutiny thrown all on top of them. And this is something that Peter Lynch really does talk about in his book One Up on Wall Street, where it's like that is the one advantage you do have as quote unquote like the mom and pop retail investor, just being your own personal investor, is the one, no one can tell you like, oh, you are under diversified or anything like that, because diversification is the thing, because it is if you have that high conviction, it is that high, and you just know it's everything's lining up perfectly for you in that like one company, and how you feel about it, that trade, whatever fundamentals, you've done your research, etc. The people who run these ETFs, these funds, they don't have that privilege of being able to leverage their funds that way. That will lead to ultimate outperformance. They gotta please all these crowds, they gotta please all these other people, and that's something that you as the individual don't have to do. So just keep that in mind. Keep that in mind anytime you invest in any ETF, especially thematic ETFs. Sometimes I personally do believe that you might be better off, if you do have great experience, just reading into companies, really reading into what the ETFs and some of the major fund managers are holding, reading into the industry a lot, doing your own personal research, and then picking a company after you've done good thorough. I think that's where a lot of the real potential for performance lies. I don't think it's so much in these ETFs, if I'm going to be straight up honest with you. But man, this space, the gene editing space, man, this is really a space. I'll tell you what, I do not know where or when this space is going to go. And I think this is a space where it is going to be really, really hard to pick the winners in this space, especially. But these ETFs, they're going to have them. They're going to have the winners. They're going to be there. The fund managers are going to allocate that out. Whether they're passive or active, we're going to go into that later. And the fund manager, they're going to be the ones to adjust as they best see fit. You're not going to be the one to do that. Now, that could be a good or bad thing, as I said in my diversification rant. If you just really want to be that person who's like, I have good understanding maybe about the science of this space, but I don't really know anything about like companies or stock market or anything, like reading 10Ks, whatever, all that businessy stuff, then this is kind of going to be that type of investment vehicle for you. You buy your index fund, and then on top of that, you hold something like an ETF, like these, like the ones I'm going to go into that are thematically based around gene editing and this genomic space. But like I said, there are going to be some people with higher risk thresholds who are like, no, I won't do this research myself, find this company myself. And I think those people who really do that, get it right, they're going to be the ones who really reap that especially high performance. That's not to say that these ETFs can't have great performance, because they certainly could still have great performance, just not like phenomenally amazing performance, because they're not one entity who's taking over the gene editing space. It's going to be a basket where some are going to fail, some are going to do great. So getting into our first ETF here, you got from Global X, you got GNOM, Genome. Global X, you're talking about a firm with $47 billion assets under management. By Murray Asset, it's a pretty new firm. You're looking at 0.50 expense ratio on this fund. By comparison, I think a lot of Vanguard and Fidelity funds are 0.08, 0.06. So you got to keep that in mind, you know, when you're doing these thematic type of ETFs or whatever. That's a lot of residual capital gains that you're kind of paying almost like a slight little tax to the fund managers, and that's what they collect. That's how they make their living. This fund's gonna look to follow a benchmark that's called the Selective Genome Index. You could look into that if you'd like. You're looking at 40 total holdings, and this is gonna be passively updated by a fund manager every so often, every quarter or something, every sequential part. They're not going to change on. As you can see here, they've advertised some reasons to consider the ETF that I've touched on in previous slides, such as the structural tailwinds, how it was over $100 million in 2001, 2002. Now it's less than $1,000, 2020. It does target your exposure to healthcare and healthcare technology. So if that's something you kind of want to kilt your exposure to, and yeah, it does have high growth potential, as that graphic does say. Has to do with innovations of new genetic medicines, new therapeutics, really solving those areas of growing demand of tackling disease. But yeah, you can see some of the holdings here on the right. A couple of the holdings I think are kind of the top two holdings here. I kind of see mostly in this fund. So looking at Sarita Therapeutics and Alanylam Pharmacy, they're kind of more only in genome. Those are over a 6% and over a 5% allocation respectively. You're looking at Beam, which is almost a 5% allocation. That's going to be in a lot of the different funds, as well as Crispr Therapeutics, which is the company that did the beta thalassemia trials I talked about earlier in my last slides. Natra, BioMartin, Intellia, you're going to see that one in a few of the other funds. Biogen, BioNTech, you're going to see this in at least one of the other funds. Specific Biosciences down there towards the bottom, you're going to see that in some of the other funds. But yeah, this is a really interesting portfolio. I just will say again, Global X, they kind of are like a newer firm. Just something to be cognizant of. But they could be real trailblazers here. They could be real innovators in this space, and I really do like how this is kind of a unique portfolio. I really haven't seen any portfolio quite like this. So I might look into what the Selective Genome Index is. Next one from ARK Invest, you got ARKG. ARK is a very new investment firm. They were headquartered over in the New York area, but they've recently moved to the St. Petersburg, kind of like techie part of like the Tampa, Florida area. They got 14.11 billion assets under management last time I checked. You talk about ARK, you're going to be talking about Cathie Wood. She's going to be the manager of most of these funds. You got her photo there at the bottom. It's an active fund, so they're going to have day-to-day trades and email listing you can subscribe to. They will trade on daily news, daily research that comes out, things like that. I won't get too ahead of yourselves on that because there is a lot of research about like overactivity can really like draw back from an investor performance. So it sounds really cool and it sounds really innovative, getting into active fund like that at first. But I feel like you have to really like know the manager, know like what's going on behind the scenes, et cetera, to really like feel like that's being done well. Also, this fund, you're talking about all things genomic revolution. What I mean by that is they're kind of stretching the definition a little bit. They're going to invest a little bit more in like med tech, things that can maybe like somewhat relate to the healthcare space, next generation healthcare space. So for example, when I was looking at their portfolio last time, they had Teladoc, and sure enough, there it is, number 6 holding. 4% of the portfolio. Teladoc, they're not directly doing any type of gene editing science, actually looking at like human nucleotides, and they're not doing that stuff. You're also looking at a 0.75 expense ratio. It is a little bit higher expense ratio. These managers are going to take a little bit more of the pie at the end of the day. Like I said, they are an active fund. They are doing things a little bit more their way. So if it does play out like their way, 10 years down the line or whatever, and you were a part of this, then you will be rewarded rewarded very handsomely. One critique I will say is I don't really like how ARK Invest has hedged around like an interest rate rise from the Fed and stuff like that. Like they were sending a letter about how like to the Fed about, oh, we think you should lower the rates and things of that nature. But I mean, the Fed is an independent entity, and I feel like it's just your job as an investor to really just play around that stuff. They haven't seemed to do that very well. So I think that just kind of like puts some taint on them that it is kind of hard to trust capital with them. I saw in the ARKG fund that over the last 5 years, almost all of that shareholder wealth has been eliminated. This is definitely like one of the most like non-establishment like financial industry type funds. As I said, they're like a smaller firm, newer firm.
And we see the first human genome was sequenced for a cost of almost $3 billion and took 13 years of computing power. We're now down to, less than $1,000 per human genome in a day or so. And by 2021, we think we'll be at $100, so that DNA sequencing will become part of our annual physicals. And DNA sequencing will be able to identify where our genes have mutated and why we have certain kinds of diseases. We're also, with CRISPR technology and CAR-T technology, going to learn about ways of actually curing disease. CRISPR technology, CRISPR-Cas9 specifically, is gene editing. Now, gene editing is really not new. We had a gene editing technology called zinc finger nuclease. And that has achieved some success, but it's extremely expensive, about $5,500 per base pair of DNA that's edited. Today, CRISPR-Cas9 can edit at $30 per base pair, so huge drop in the costs. Gene editing is exactly what it says, editing. It's cutting, activating, silencing, regulating. We call it the molecular Swiss Army knife. In essence, gene editing can reprogram the mutations in our DNA. Our DNA starts out usually just fine, and then mutations happen along the way, and now we have a technology that can edit them away. To give you a sense of how important this is, only 5% of the monogenic diseases, so the diseases caused by one gene, only 5% of them are treatable today. With gene editing, all of them potentially will be treatable. And then beyond that, monogenic is only 2% of all the genes out there. So if I were to tell you that if we were able to solve all the problems for people with monogenic disease, that's a $2 trillion opportunity, can you imagine how big the polygenic opportunity is going to be? This is really one of the most exciting investment ideas we have ever experienced.
Next, we are on to iDNA from Blackrock. This is the iShares Genomics, Immunology, and Healthcare ETF. When you're talking about Blackrock, you're talking about $10 trillion assets under management. You're talking about one of the biggest assets under management firms in the world, pretty much. I mean, certainly up there with like Vanguard, Fidelity. This is also going to be the lowest expense ratio out of all the funds mentioned here today with 0.47. So slightly lower expense ratio than the Global X fund. It's going to be another fund that's passively updated. It's not going to do like daily trades. It's not going to trade so hotly on news, things of that nature. The fund has 41 holdings as of today. One thing I do really want to note is Blackrock, that's a firm that's been around for like a long time, decades on decades. Blackrock, they're going to have more assets under management, and I do believe that their managers are going to come with like a lot more experience, just a lot more credibility, a lot more years under their belt. Also, another thing about this portfolio is there's also more big cap stocks. There's also more profitable companies in this portfolio. I know on the BlackRock website, they actually listed this portfolio has a PE for the profitable companies. They have a little like asterisk note that this is the price to earnings for like what they could quantify. So essentially they're excluding artificially all the cash burn companies in this portfolio, because you will see names over here at the right that are in the ARKG portfolio and things of that nature that are, and ARKG is predominantly comprised of cash burn companies, and it is kind of nice actually seeing IDNA and ARKG sharing some names, but definitely they are very separate portfolios. So for example, we break this down, you got Intellia there at a 4.83% allocation. Now ARKG also is going to hold Intellia, of course, but I mean that is very much like it's a cash burn company. Now if you don't know what I mean by that, their companies spending very hotly on their own research and development, on their own growth projections, their own they're spending money to get the company afloat, to get it into a real tangible product, to get all the research under their belt, all that complex genomic stuff they gotta do. And they're hoping, like many other companies, like Tesla's recently done the last couple of years, to transition out of this growth model at some point in their company's maturity phase into a phase where they actually have tangible products that have gone through pipelines, been improved out there on the market, and they are turning a profit, and then they are profitable. It's going to be really hard to find profitable companies that are operating in this type of space, because this is really truly a space of the future. I mean, when you're talking about genomics, so that's why it seems to me like BlackRock really stretched the definition here with IDNA. They went for genomics, immunology, and healthcare ETF. But that really makes sense to me, because with everything I know about how BlackRock likes to structure portfolios and whatnot, they really like to just have some protection to the downside and really just allow for that upside to still happen. BlackRock is not one to operate a portfolio like the one you're going to find at ARK. I mean, it's just not the ways. They're much more of an establishment kind of firm. They're going to be a lot more conservative with what they want to hold. So let's continue down this list, shall we? Right below Intellia, you'll see Regeneron Pharmaceutical, 4.78% allocation. Regeneron is actually very much a profitable company. They have mature products in the pharmaceutical space that are developed. They're most recently in the news a couple years ago for the CV19 cocktail. If someone got really badly sick with CV19, they would get this antibody cocktail, and that was made from Regeneron. Regeneron got a whole bunch of business out of that thing. Really put their name quite on the map too. Yeah, that's like a much higher mega cap company, worth several $billion, profitable, and it's got that high allocation in this portfolio. You also see Moderna there at a 3.85% allocation. I own some Moderna myself. I have a video about Moderna. You could find it here on my channel. Takeda right below that one, 3.81% allocation. That's going to be another profitable company coming out of Japan, mega cap pharmaceutical. Fate Therapeutics, that's an interesting one. You see that one in some of the other funds. I don't believe that's so much of a mature company. BioNTech, that's definitely a much more mature company, profitable pharmaceutical, very involved with Pfizer's vaccine that came out recently. We're actually the ones to essentially discover the antibody that went into Pfizer's vaccine. Pfizer just really developed, and Pfizer was really the ones that just develop it and scale it out in mass. But BioNTech, I mean, they were the ones who had the mRNA technology to really go out there and find the antibody and use that mRNA application for a vaccine that was effective. Like I said, it's a profitable company. I mean, they do cell therapy science, all these other things on top of mRNA science, and they've been able to turn a profit with all their recent success in the last couple of years. As you can see, I mean, it's just a different portfolio. This is going to follow the New York Stock Exchange FactSet Global Genomics and Immunobiopharma Index. And yeah, I mean, that is IDNA from BlackRock, from their iShares. Out of all three of the funds, if I'm going to be honest with you guys, I think this is the one that I'm most interested in. I actually have a couple shares of this one just kind of for fun. With how the market's been looking, I sometimes think about buying more. It is really interesting, obviously, with the markets going down, you kind of do want to buy more. But yeah, like I said, it's just really interesting space. I'm very bullish, very optimistic about it in the future. But one thing I do want to say about this space, though, is I'm not particularly expecting this thing to be a smooth ride. I think it's just going to be tons of bumps along the way. I also think it's very highly likely that we are just early. And I do hate to say that, because we never know when those gains are going to come as investors. We could be uninvolved with these stocks, this type of space, and within the next year or the year after that, that's when a lot of the gains really come through. Some big research comes out or something, and we missed a lot of that initial part of those gains. So I do think it's not a bad idea to maybe plant the seed now in this space, maybe take a nibble out of some of these things that might interest you. But I just want to really reiterate that I think you will have time here. I do think that these technologies, I think a lot of research and cash burn is going to have to go into that in the next couple of years here. And I think what we've seen with beta thalassemia, I think as that's kind of seen with a couple more kind of like niche diseases, as we see like these kinds of gene editing space kind of solve these diseases, we're going to start to really notice that trend. And I think that's when we can really make that inference that, oh, hey, this technology, it is actually finally really especially here now, because we're just seeing it in the news so much more. The research is really coming out about it. It is solving a lot more problems. It's just seeming like a lot more of a here and now kind of product. I think that's when you maybe want to like start really getting into it. But I'm just kind of making the point that I just think a lot of these companies will be at like purchasable prices for the foreseeable future. And I think another thing I just want to note is that if they do see some big pop, and especially in companies like this, it could very well be short-lived. Like it could just be on some news or something, maybe some like 20% pop in the company overnight, 30% pop in the company overnight. But it's like, what are the odds that that's actually short-lived? You know what I'm saying? So it's just kind of definitely take your time if you're trying to invest in this space. Don't rush anything. Don't make hasty decisions. A lot of this stuff's going to move on news in the short term, but in the long term, a lot of the fundamentals should play out about like the science and what's going to happen here with this space and all the problems that it could and will solve. Just be patient, take your time, do a lot more research. Don't feel like this is something you got to like pile into today. And yeah, with that being said, I do fancy IDNA from Blackrock the most, the lowest expense ratio. The managers will be the most experienced. And we are going to have a mix of profitable companies in there. Just give us a little bit of a smoother ride probably in the longer term. Is it possible that IDNA gets hand over fist outperformed by something like ARKG? Yeah, it's possible, but I also think the odds of IDNA going into more or less a bankrupt fund are a lot lower compared to ARKG. So in this video, I hope I really brushed on how you should maybe in some degree be skeptical of these thematic ETFs. Like I said, you know, these fund managers, they're going to collect a lot more of a hefty expense ratio out of you if you're trying to invest in one of these vehicles, as well as diversification. That's just a huge risk you're going to run here. In the long term, you might be kicking yourself that, oh, why didn't I buy this company in that space? Why didn't I just buy that company in that space? I would have done so much better. You know, my ETF maybe didn't have such a great performance. Well, if you want to go ahead and be that type of person and go ahead and start looking at equities, these are the places I would start if I was. So all these, I got 5 names over here at the left. All these are coming from the 3 funds in this video, and they're just ones that I've especially taken notice of. They are on my watch list, and I'm going to go ahead and share them with you. The first one being CRSP, Crispr Therapeutics. This is a leader in the space. I mean, absolutely, definitely one of the higher valuation companies. They are actually profitable last time I seen, with, you know, just how much their revenues have gone up and things of that nature. Definitely to me, one of the more intriguing companies I'd be more interested in. They were the company that did have that curing of beta thalassemia trial that I aforementioned in that video. Again, I just really think they're a better value here. The way the balance sheet's looking, the revenue statements, all that. Just a lot more clear and concise of a vision of where this company is going. The trajectory is just a lot more clear to me compared to a lot of the other smaller cap kind of companies. The kind of companies that were founded a lot later compared to Crispr, and the money that Crispr are spending on research, development, etc. I mean, it seems very like much more affordable, makes a lot more sense to me. It's not like you're just investing in a product without a plan, if that makes sense. They seem to have a lot more of a plan. Intellia, I mean, like Crispr, these guys just seem to be so much farther ahead compared to so many of the other companies when it comes to research, development, things of that nature. For all I know, their research could be like well ahead and well better off longer term being here than you could be in something like Crispr. But the one thing I will say is Intellia, to me, last I checked, they do seem to still very much be on that cash burn kind of phase of their company. So you are running some risk. You are buying into a hotter valued asset. A lot of that valuation is a lot more rooted in projections and intangible visions of the future. It's not so much rooted in what dollar amount is that company earning. So yeah, sometimes you know, buying into companies like that where their valuation is not so much rooted in a fundamental realized dollar amount reality, it can be kind of difficult and challenging for some certain investors. I definitely don't have an issue with it compared to a lot of other value investors I know, but it's something I definitely want you to be aware of, especially, you know, if you're coming to this video. Just a lot of these companies are cash burn, and Intellia is definitely going to be one of them. So BioNTech, this is going to be a company that I do own. I do have some great videos on my channel about this company if you would like to check them out. Very excited about this company. This company doing mRNA and cell therapy science, trading at amazing value, got a great balance sheet, amazing balance sheet, very little to no debt, little to no liabilities comparative to their assets. And this is a company that really did go out there and
do the groundwork and discover the CV19 antibody that went into the Pfizer vaccination. So incredible company. I think that there's going to be a lot more amazing discoveries from them in the future. I was really excited to see them in the IGNA portfolio, and that was actually one of the catalysts to really make me pull the trigger on just getting some shares of this company myself. Sometimes, you know, just seeing that another investment entity that you trust is holding that asset that you're interested in, it can really just catalyze, reaffirm your own decision making. The last ticker I want to talk about here today is Beam Therapeutics. I actually don't know a lot about Beam. I believe they are in the cash burn stage of the company. But one thing I do want to say is there's a pretty hefty allocation in all three of these funds towards Beam. IGNA, GNOM, ARKG, all three of them had a good couple percentages in Beam Therapeutics. So whatever's got going on at Beam might be worth your interest, might be worth you taking a look, especially if you're interested in this space and investing in this space. All right, guys, thank you so much for watching my presentation. I hope you really enjoyed it. This is a great equity research presentation on three of the biggest funds that you're going to see really in the gene editing space, in the public ETF space, for, you know, gene editing genomics. This is going to be a really exciting space, especially like the next decade or so, next couple decades. I just really encourage you to stretch out your timeline. Don't feel like you're in a rush or whatever to get involved here. I don't think this is going to take off tomorrow. Anything like that. If it did happen and this stuff did take off tomorrow, it'd be kind of a feeling I'd be pretty lukewarm to, because I definitely have planted some of the seeds with picking up some IGNA shares for myself, you know, getting involved with companies like BioNTech, Moderna, etc. But I definitely don't feel like I've accumulated enough, as much as I'd like to for the long term. But, you know, I'm riding the tide, you know what I'm saying? I think you should too. I think you should ride the tide here. I don't think that there's going to be just this big, massive wave that comes out of nowhere and all the gains just come overnight or whatever. And I think you got to be really cognizant of short-term news in this space, because a lot of investors get really excited about research when research gets published in this space. Get really excited about research findings, projects that'll come out, and it can lead to short-term spikes. And yeah, although the long-term fundamentals do approve on those announcements, just don't expect that the entirety of that long-term pricing in will be priced in like overnight. Be skeptical of those big plus 30% type gains you might see in the pre-market or whatever with some of these stocks. So yeah, that's just, you know, another forewarning. Take your time with this space. Don't buy into the hype. Be really cognizant. But yeah, there's a lot to be excited about for the future here. I certainly am excited. I hope you are too. Thank you so much for checking out my video. Peace.